Hello, my name is Jesse Colombo, and in today's presentation, I'm going to explain why silver's bull market has officially begun. Although gold launched into a powerful bull market in early 2024, silver lagged behind, trading mostly sideways from May 2024 to June 2025, as it repeatedly struggled beneath the $32 to $35 resistance zone. While gold soared from $2,000 to over $3,000 during that time, silver, which is normally closely correlated, became increasingly undervalued by comparison and set the stage for an eventual breakout of its own. As silver continued to underperform, many investors grew increasingly frustrated and pessimistic, believing it was doomed to languish indefinitely. But throughout that period, I published numerous reports and analyses urging investors to stay patient, emphasizing that silver had a bright future and was on the verge of launching a bull market of its own, much like gold. Sure enough, on June 5th, silver finally surged and broke through the stubborn $32 to $35 resistance zone that had capped its gains for over a year. As soon as that barrier was cleared, it became clear to me that silver's long-awaited bull market had officially begun. Since then, silver has continued its climb to just under $41 an ounce. But I believe the most significant gains still lie ahead, as I will explain throughout this presentation. Due to silver's frequent false moves and susceptibility to manipulation, I also track silver priced in euros for added confirmation. This approach also filters out US dollar fluctuations and helps reveal whether silver is genuinely showing strength on its own. Silver priced in euros had been stuck below a key resistance zone between 29 and 32 euros, so I closely monitored that level, believing a breakout would serve as another important confirmation that silver's bull market had officially begun. On July 11th, silver priced in euros finally broke through the resistance zone that had capped its gains for over a year, which I took as a strong confirmation that silver had entered a major new bull market. Given my natural skepticism and experience with past false breakouts in silver, I wanted to be absolutely certain that the recent breakout was genuine. For added confirmation, I turned to a proprietary indicator I had developed last year called the Synthetic Silver Price Index, or SSPI. The SSPI is essentially an average of gold and copper, with added weighting to maintain consistent proportions within the index. Both gold and copper significantly influence silver's price through arbitrage algorithms. Interestingly, even though silver itself is not a component of the SSPI, the index maintains a 95% correlation with silver. Because of this strong relationship, I found the SSPI to be an extremely effective tool for confirming silver's moves. For example, if the SSPI doesn't confirm a move in silver, that move is often a false one. As it turns out, the SSPI formed a bullish chart pattern over the summer known as an ascending triangle, and it broke out of that pattern on September 1st. This breakout signaled that the index was poised for a significant move higher and provided strong confirmation that silver's nascent bull market was indeed legitimate and underway. After witnessing breakouts in silver priced in both US dollars and euros, followed by a breakout in the SSPI, I became increasingly confident that silver's bull market was the real deal. Now that silver has broken out above its $32 to $35 resistance zone, I want to highlight the parallel with gold, which from 2020 to 2024 was similarly capped below a major resistance zone between $2,000 and $2,100. This ceiling kept the price of gold suppressed for years, until it finally broke out in early 2024, igniting the powerful bull market it remains in today. Now that silver has decisively broken out, there is a very strong chance it will follow in gold's footsteps, and it's even likely to outperform gold for the near future, due to how cheap it is compared to gold, as I will show later in this presentation. Now that silver's bull market is officially underway, my focus has shifted to the next major hurdle and opportunity, a massive cup and handle pattern that dates all the way back to the 1960s. Given the magnitude of this formation, it indicates the potential for silver to reach several $100s per ounce over the course of this bull market. All that's needed to confirm this massive pattern and trigger this exciting scenario is a decisive close above $50 an ounce, which is the level that marked silver's all-time highs in both 1980 and 2011. With silver currently just under $41, it is now less than $10 away from launching the most powerful bull market in its history. Despite silver's recent strong performance, it still has substantial upside potential. Several valuation metrics, including the long-term gold-to-silver ratio, indicate that silver remains significantly undervalued. The current gold-to-silver ratio stands at 88.8, but if it were to revert to its historical average of 53, dating back to 1915, without any increase in gold's price, silver would be valued at approximately $69 per ounce, representing a nearly 70% gain from its current price of $40.91. Naturally, as silver rises to close this gap, the ratio would decline accordingly. Adjusting silver's price for inflation further highlights how undervalued it is by historical standards. During the Hunt brothers-related spike in 1980, silver reached an inflation-adjusted price of $198 an ounce. In the 2011 bull market, driven by quantitative easing, it hit $72. Currently trading at just $40.91, silver has significant room to rise if it's to catch up with these previous inflation-adjusted peaks. If you're enjoying this content so far, please consider subscribing to my best-selling Substack newsletter called The Bubble Report, that can be found in the description below. The Bubble Report features detailed analyses of precious metals and comprehensive reports about global economic risks, including dangerous bubbles that are ready to burst at any moment. With over 10,000 subscribers, the Bubble Report has become one of the most popular precious metals newsletters in the world, and a major hit among investors. I invite you to give it a try. You'll find it packed with valuable insights. Another way to assess whether silver is undervalued or overvalued is by comparing it to various money supply measures. The chart on this slide shows the ratio of silver's price to the United States money supply, providing insight into whether silver is keeping pace with, outpacing, or lagging behind money supply growth. If silver's price significantly outpaces money supply growth, the likelihood of a strong correction increases. Conversely, if silver lags behind money supply growth, it suggests a potential period of strength ahead. Silver has trailed money supply growth for the past decade. This divergence, along with other key factors discussed here, sets the stage for a significant upward revaluation. A key driver of silver's recent surge has been the unwinding of massive short positions, or bets against the price of silver by swap dealers, which are primarily the trading desks of major bullion banks like JP Morgan and UBS. They've been covering aggressively since early July, as silver prices have climbed, and there's likely still more short covering ahead. At the beginning of July, the swap dealer net short position stood at 54,388 contracts, which was the largest it had been in recent memory, and was equivalent to 272 million ounces of silver, or roughly one-third of annual global silver production. This meant that every $1 increase in the price of silver would translate into a $272 million loss for those dealers. It is easy to see why they were on edge, and eager to reduce their massive bet against silver. As a result, over the following 2 months, swap dealers aggressively reduced their short positions by 45%, bringing their net short position down to 29,721 contracts. This is equivalent to 149 million ounces of silver, or approximately 18% of annual global silver production. As silver's rally continues, it is likely that swap dealers will further cover their short positions, and may even begin building a net long position. This would add even more bullish pressure to the price of silver. The risk of an explosive silver short squeeze is further amplified by the astonishing ratio of 361 ounces of paper silver, which includes exchange-traded funds, futures, and other derivatives, for every single ounce of physical silver. In a violent short squeeze, holders of paper silver could be forced to scramble for the extremely scarce physical silver to fulfill their contractual obligations. This would cause the price of paper silver products to collapse, while physical silver prices would skyrocket to jaw-dropping levels, potentially reaching several $100s per ounce. This event is what may fulfill the price target implied by the cup and handle pattern I showed earlier. One of the biggest drivers of silver's bull market comes down to basic economics 101, supply and demand. Over the past 5 years, silver demand has consistently exceeded supply, resulting in a persistent deficit, as shown in this chart. In 2024 alone, the shortfall reached 182 million ounces, with an estimated additional 117 million ounces this year, and deficits are expected to continue for the foreseeable future. As a result, above-ground silver stocks are dwindling rapidly. While bullion banks can create unlimited amounts of paper silver in an attempt to suppress prices, they can't manufacture the real physical silver that is crucial for a wide range of industries, alongside growing investment demand. The persistent silver deficit is the result of both shrinking supply and rising demand, a combination that is finally pushing prices higher after years of stagnation. On the supply side, global silver mine production has peaked and declined over the past decade, as economically viable deposits become depleted. As silver production declines, demand for physical silver has surged across multiple sectors, driven primarily by the rapid growth in solar panel manufacturing. Silver demand for photovoltaic or solar panel applications alone has nearly tripled over the past 4 years, increasing by an impressive 143.1 million ounces. As the world transitions from fossil fuels to renewable energy, the shift is still in its early stages, and global efforts to expand clean energy are set to drive demand even higher. Now that we've established that a major bull market in silver is underway, I'd like to briefly share my favorite ways to invest in it. I'm a big fan of the most obvious and straightforward approach, owning physical silver bullion in the form of coins and bars. However, I also invest in silver mining stocks and exchange-traded funds for their greater upside potential, especially given my higher-than-average risk tolerance. These stocks are leveraged to the price of silver and tend to move more dramatically, both up and down, so they're not for the faint of heart. While riskier than holding bullion, they can offer explosive returns as silver truly takes off. I use the Global X Silver Miners ETF, which trades under the symbol SIL, as a useful proxy to track the performance of silver mining stocks. SIL broke out of a long-term triangle pattern earlier this year, which is a bullish development. In addition, the monthly chart of SIL shows a decisive breakout above the critical $48 to $52 resistance zone that has capped gains since 2016, which I view as a major bullish signal. Junior silver mining stocks, which had been lagging until recently, are now waking up in a big way, and I am very bullish on their outlook. The most popular junior silver mining ETF, trading under the symbol SILJ, recently broke out of a long-term triangle pattern that dates back to 2013. Now that a decisive breakout has occurred, I expect explosive upside potential, particularly since junior mining stocks are highly leveraged to the price of the underlying metals and often outperform during broad precious metals bull markets. With this presentation coming to a close, let's review some of the topics we've discussed. After years of underperformance and trailing behind gold, silver is now well positioned for a sharp and aggressive catch-up. Although silver has rallied recently, it remains undervalued by several key measures and still has plenty of room to move significantly higher. Over the long term, a combination of fundamental and technical factors is likely to drive silver to at least $300 per ounce. If you enjoyed this presentation and want access to more of my content, I encourage you to subscribe to my best-selling Substack newsletter using the link in the description below. Once again, I'm Jesse Colombo, and thanks for watching.